Welcome, everyone, to the Lutz Annual Individual and Business Tax Update. A couple of quick housekeeping items before we begin. If you have any questions, you can send those through the chat, but we will be addressing those at the end of the presentation. And as for the slides, yes, we will be sending out copies of the slides and recording of the presentation to everyone who's in attendance after we give our talk. A little bit about us. I'm Dan Sweeney. I'm a tax director here in the Omaha office.
And I am Leslie Masek, and I am a tax manager in our Lincoln office.
Jumping right into it, here's our agenda for this afternoon. We want to go over the One Big Beautiful Bill, which probably a lot of people have questions on or want to know more about, and just all the different tax changes that happened in July of this year. We have our individual updates, we have our business updates, get into a couple of different planning opportunities, and then we'll address the Nebraska updates that are out there as well. Where it makes the most sense to start is with the review of the Tax Cuts and Jobs Act. For those of you that watched this presentation last year, we were talking about we have all these different limitations that are set to expire starting in 2026. What are we going to do if we don't get some type of tax reform? Brackets will go down, different provisions will stop, a lot of different tax code provisions sunset and just stop starting 1/1 in 2026. So here on this slide are some of the highlights of what was in the Tax Cuts and Jobs Act from 2017, some of the highlights of those provisions. When we look at the One Big Beautiful Bill, what I think is important is if we look at a little bit of the history, because really there were three different versions of this bill that were out there. And some of the provisions in there were a little bit different depending on what type of the bill you were looking at. So we had the initial House bill, then we had a Senate Finance Committee bill, then we had a final Senate bill. And the final Senate bill is the one that ultimately got passed and signed into law. So keep in mind that there were three different versions of this bill that were floating out there. Some of the tax provisions did change over time from the House bill over to the Senate bill. There were quite a few provisions in the House bill that never ultimately made it into the final bill itself. So if you're wondering, well, how come they're not talking about that? It's likely because it just never made it into the final bill. What we're talking about here this afternoon is all the provisions that were final in the Senate version of the tax. As for the One Big Beautiful Bill itself, it had several different sections addressing a lot of different areas. What we're focusing on, though, is just the tax updates. It's a pretty big bill overall, but we're just focusing on what happened with the different tax changes that were ongoing.
All right, so we'll go ahead and get started with individual updates. Beginning with the TCJA provisions that were set to expire and were modified, extended, or made permanent. First off, we'll go over the tax brackets and standard deduction rates that have both been made permanent with the OBBA. Before the TCJA, the highest individual tax rate was 39.6%, but then the TCJA enacted the tax brackets that we've been known to become more familiar with, which is the 10, 12, 22% rates, with the 37% rate being the highest. Those brackets were set to expire, but have now been made permanent, so we will keep seeing those year over year going forward. Also, before the TCJA, some of you may remember that we had personal exemptions that individuals would take on their income tax return based on the number of individuals in their household, which with the TCJA were taken away. And now those have been permanently taken away, which means that the standard deduction rates now are permanently at an increased rate. So as you can see on the screen, if you are filing for single in 2025, your standard deduction was supposed to be $15,000, but now with the new One Big Beautiful Bill, it has been increased to $15,750.
And one thing that Leslie mentioned there, you'll hear a lot there, now made permanent, now made permanent. That's the trend of what happened in the new tax bill. With a lot of the Tax Cuts and Jobs provisions, we were concerned that were going to expire starting next year. Most of them became permanent going forward. So now we have a little bit more consistency about what to expect and how to plan for the future. Now that we know things aren't going to disappear or just be kicked down the road for another 5 years or so.
Here we have the 2025 individual income tax brackets. Like I said, we have the usual brackets that we've seen, 10, 12, 22, and so on. But it is the income within the brackets that changes year over year and increases usually as an inflation adjustment. So you might notice that the biggest jump from brackets is from 12 to 22%, which increases by 10%, the largest jump. And then we don't have a slide on this, but I also wanted to mention that C corporations do have a permanent 21% tax bracket or tax rate. This rate was made permanent with the TCJA, and I know with the different bills, there was some talks about changing the C corporation rate, but it is still at 21%. Before the TCJA, I believe the highest rate was 35%, but again, still at 21%. And this next slide shows the 2026 individual rates, same brackets, just know that the income limits have increased with inflation, in which have done so, year over year. Not a big change there. And then finally for brackets, we also have the capital gain rates for 2025, which weren't set to change or didn't really change at all with the one big beautiful bill, but it's just good to know that these are the brackets and they range from 0, 15, and 20% based on your income level. Moving into some of the changes with the one big beautiful bill, like I previously mentioned, pre-TCJA, we did have personal exemptions, which then were eliminated with TCJA and now have been permanently eliminated. But now, starting in 2025, we do have this enhanced deduction for seniors, which is temporary, so it's only supposed to last through 2028 unless Congress decides to act and extend or make it permanent. But it is a $6,000 deduction for individuals that are age 65 and over. Keep in mind, if both you and your spouse are over 65, you could get up to $12,000 of this additional deduction. But there are phase outs that begins at $75,000 for single and $150,000 AGI for married filing joints. And I know Trump, when he was campaigning, he talked about wanting to have no tax on Social Security benefits, which didn't happen. But a lot of people think that this new senior deduction is kind of a replacement for that no tax on Social Security. But keep in mind that, if you're over 65, whether or not you take Social Security, you do get this deduction. So the chart there shows that for 2025, if you're filing single, you get the $15,750 standard deduction plus an extra $2,000 deduction that's been in play if you're over 65 and or blind. And then there's also the new temporary deduction of up to $6,000. So that's a pretty good chunk of change that you could get in deductions starting in 2025.
If we zoom out a little bit too, I think this is also good to mention as we go through these provisions. While I mentioned a lot of the Tax Cuts and Jobs Act provisions were now made permanent for the most part, for any of the new provisions, those typically do end at the end of 2028. So when we talk about some of the new things that were introduced, those do just have a time limit on those before they disappear. A lot of our old stuff was made permanent, but the new stuff, they will have time limits as to how long it will last.
The qualified business income deduction, also known as the QBI deduction, was also made permanent. So this is a 20% deduction that individuals can take on their pass-through or single member LLC income. This also came about with the TCJA, and it was enacted to kind of even the playing field for C corporations versus pass-through entities, because C corporations do have this preferential 21% tax rate, whereas if you have an S corporation or partnership, that income could be taxed at 37% if you're in the highest tax bracket. So this QBI deduction was put into play. It does have some limitations, income limitations, as well as wage and property limitations, some phase out ranges. But just know that with the new bill, there were a lot of talks about, changing the QBI deduction rate, but it did stay at 20%. And there are even more limitations based on if you're considered a qualified business or a specified trade or business, which we'll talk about a little bit more in the next slide. But one other change besides this becoming permanent was now there's this $400 minimum deduction for active QBI. So for some instances where your income is high enough and your QBI would be phased out to $0, it's possible for you to get a $400 minimum deduction if this is considered active QBI. And that is mainly considered if it's, again, active versus passive is a big consideration when considering, the whole active QBI thing. Here we just have a summary of the QBI deduction because, like I said, there are many factors that come into play and different phase outs and limitations. But really, if you're able to take this deduction, you'll be in one of three buckets. The first one is if you're below the income threshold, you can take the 20% deduction, whether you're considered a specialized trade or business or not. If you're within the income threshold, you may be phased out to zero if you're an SSTB. If you're not an SSTB, this is where you have the W-2 and property limitations. And then if your taxable income is above that threshold, you have no QBI deduction if you're an SSTB. And once again, non-SSTBs have the W-2 and property limitations, which may phase them to zero. But keep in mind, if you were supposed to be phased to zero, you could still potentially get that $400 minimum deduction. And again, there's lots of different scenarios for this, but usually when you put your pass-through information into our tax software or a tax software, the tax return can automatically calc your QBI deduction, but it's kind of just good to know how the calculation is calculated and whether or not the software is actually calculating it correctly. The child tax credit was also permanently increased with the new bill. So it went from $2,000 in 2024 to now $2,200 per child in 2025. This will be indexed for inflation. $1,700 of it is refundable, and the $500 credit for other dependents was also made permanent. But keep in mind that in order to claim this credit on your income tax return, both the child and taxpayer and or spouse have to have a social security number. Next, we are going to talk about some of the itemized deduction updates. A little bit of background information for any of you that aren't familiar is when you're filing your personal income tax return, you're able to take either the standard deduction or an itemized deduction, which generally consists of medical expenses, state taxes, mortgage interest, and donations. The TCJA capped the state and local tax deduction at $10,000. And generally what you deduct for state taxes is state income taxes, which would be withheld from your W-2, real estate taxes, personal property taxes, or sales taxes. When this new $10,000 cap came into play, a lot of states came out with the pass-through entity tax deduction, also known as PTET, which shifted the business's state income taxes from being paid by the individual to now being deducted on the pass-through entity return, since individuals were limited to $10,000. When the new bill was coming out, there were a lot of different talks about increasing the cap or getting rid of it, and even putting in some PTET restrictions. But just know that with the final bill, there are no PTET restrictions. And also the SALT cap has been temporarily increased to $40,000 starting in 2025. There are adjusted gross income phase out ranges, which you can see on the screen, and year over year, the AGI or the SALT limit is going to increase by 1% each year until reverting back to $10,000 in 2030, unless again Congress decides to change it again. But that is a big update for state and local tax deductions. Historically, we've seen with the $10,000 limit and also with standard deduction rates increasing, not a lot of individuals have itemized year over year, but now that the SALT limit will be $40,000 in 25, I think it's likely that a lot of individuals will be itemizing when they haven't in prior years.
I would agree, but this probably helps out wage earners more than business owners. Because if I'm a business owner, it still makes sense to do the pass-through entity tax election that we've been doing the last number of years. Really, if I'm a high wage earner, this is a great benefit because now I do have a way to deduct those state taxes that I couldn't in the past.
Next, we'll go over charitable deduction updates. And I want to point out that both of these updates come into play in 2026. So there are no updates for 25 that you have to worry about. The first one is a new above the line charitable deduction for non-itemizers. So if you all remember back in the COVID years, I believe it was 2 years where they had this above the line deduction, and it was $300 for single filers, $600 for married filing joint, that if you don't itemize, you could take that charitable deduction if you actually made those contributions. Now that has been made permanent, but it was also increased to $1,000 or $2,000 if you're married filing joint. But starting in 2026, there is also this new 0.5% AGI floor for itemized charitable deductions. So this is really just a haircut that you have to take against your itemized deductions. So you're not going to be able to take the full 100% like you usually are. And historically, there have been charitable deduction limits. So for example, cash contributions to public charities are limited to 60% of AGI. Capital gain property that you donate is limited to 30% of AGI. Those limits are still in play, but now there is also this 0.5% floor. So since this starts in 2026, it might be important if you think you're, wanting to make some large donations, you might want to do that in 25 while you still have time, so there won't be that haircut.
As a quick comment on this, keep in mind, this starts 2026. From what I'm hearing from some people on Capitol Hill, though, this 0.5% limitation is very unpopular. It was really just a way to pay for the bill to get it to pass through some of the Senate rules. But on both sides of the aisle, they don't really like it because you're stopping some charitable deductions. So there's a very good chance that we see some other round of tax reform out there that this 0.5% goes away. But again, not till 2026. And we'll have to wait and see on that, but there's a good chance it probably won't be around going forward.
Next, we have qualified residence interest. Before the TCJA, you were able to deduct interest up to $1 million of mortgage debt. Then with the TCJA, it was limited to $750,000, which has now been made permanent. There's also an acquisition indebtedness requirement. Mortgage insurance premiums are permanently deductible, and then home equity indebtedness is excluded from qualified residence interest.
Some miscellaneous things to keep in mind of. Medical expense, that limitation did not change. One thing that can catch some people by surprise is gambling losses. This was, I would say, snuck in there where basically only 90% of my gambling losses can be deductible starting next year in 2026. So what that means is I may need to watch out for some quote unquote phantom income. Because say I wagered $100,000 and I won $100,000. Economically, I'm at $0. However, this would stop my losses at $90,000. So even though I had no cash back, I, for tax purposes, will have a $10,000 income event on my return to report. Keep in mind, this is just for the gambling. losses. It just applies on the loss side of things. So if I have significant losses for the year, my gambling losses will still be able to offset my gambling income. This is more for the situations where it's pretty razor thin and pretty equal, where there's very tiny margins on the side, where now I will have some income to pick up. And from what I understand, this is really targeted at some of the big sports bettors that use some of the sports apps where there's thin margins on there and just stop them from fully writing off all their losses. This is another provision that is not very popular on Capitol Hill. Way to fund the bill. I could see this one disappearing in the future as well. But keep in mind, if you like to gamble, you could have a situation where you have to pick up income that doesn't actually exist because you're just going to be stopped on how much of your losses you can deduct. 2% itemized deductions, completely gone. We haven't had those since the Tax Cuts and Jobs Act in 2017, so that's nothing too surprising. And then casualty losses have been opened up to state disasters starting next year too, not just the presidential disaster areas declared by the president. So more broad base of what can qualify as a casualty loss.
And in order to take gambling losses, you have to itemize, correct?
Correct. Gambling losses are one of those quote unquote other itemized deductions that weren't one of the 2% itemized deductions. So they're still around, but in order to take them, you do actually have to itemize your deductions. And it goes at the very bottom section, which just is the catch-all for all other itemized deductions. The only exception would be if I'm a professional gambler, then it would be on my business return. So in the past, prior to 2017, we had this whole piece limitation, which is a haircut on the amount of itemized deductions wealthier taxpayers could take. While that's gone, they put something in its place, which is a new reduction of 2/37 of your itemized deductions if you're a high income taxpayer. The math looks weird when you look at the statute, but what it effectively does is if I'm in the top 37% tax bracket, I'm only going to get a deduction benefit as if I was in the 35% tax bracket for my itemized deductions. So I basically lose 2% on my tax rate benefit with my itemized deductions if I'm in that top bracket. It stops me from deducting it at the 37% rate and moves me back down into the 35% bracket instead. This is another provision which isn't very popular because indirectly it harms my charitable contributions. Because if I make a big charitable gift, I can be hit by this as well, in addition to the 0.5% floor, where instead of getting a 37% tax benefit, I'm down to a 35% tax benefit. And if you do the math too, this new 2/37 limitation on my itemized deductions ends up being worse than the old piece limitation. So again, one of these provisions I don't think will probably last that long into the future whenever we see the next round of tax reform, but it is something that's out there now where you'll see just a limit, a haircut on some of your itemized deductions if you're a wealthier taxpayer. So we give an example in this slide about how this 2/37 calculation works. If you want to take a look, what we're just trying to do is trying to prove out that it really just limits your benefit to as if you were in that 35% bracket. AMT, so AMT still sticking around, but increased exemption and the phase out thresholds, and those exemption amounts will be indexed for inflation. So that was pretty much an overview of what we have from the Tax Cuts and Jobs Act that is sticking around and basically has been made permanent going forward. There are a few new provisions in the One Big Beautiful Bill, and I'm sure you've seen some of these in the media as it was going on during the summer. So there's a couple of provisions out there that's no tax on tips, no tax on overtime, no tax on car interest. Catchy slogans, but they're not actually removing the tax on those items. What it's doing is basically giving a set amount for a deduction for some of these items. So it's not getting rid of the tax completely on those items. It's not tax-free. There's just a deduction you may be able to qualify for if you meet certain requirements. So again, not getting rid of the tax on these items, just providing a potential deduction for a certain amount for some of these items. So with the tip income, this is a new deduction that's out there for $25,000. And starting in 2029, there's some income limitation phase outs, $150,000 single, $300,000 married filing jointly. I have the below the line in quotes there because it's really like a third type of deduction if you think about it. We had our above the line deductions, we have our below the line deductions, and now this is really a new hybrid type of deduction category where it's below the line, but it's not an itemized deduction. And not to get too technical, what that really means is this doesn't help me for arriving at my adjusted gross income for some of my other tax provisions for other benefits. When we talk about some of the requirements, it needs to be in cash, needs to be voluntary. So if I am out to dinner and I have one of those statements on it that says 18% is going to be charged for parties of 6 and more, mandatory, that doesn't count. Needs to be truly voluntary and there's no type of negotiation involved. No tax on overtime, similar to no tax on tips. This is just a set amount for the deduction for these types of qualifying income. And it's one of these hybrid deduction categories as well, where it's not one of our typical above the line or below the line deductions. It's not going to show up on my itemized deduction schedule. It's going to be somewhere completely different. And it's not going to help me for my adjusted gross income limitations to qualify for some of these other tax benefits that are out there. So this one's $12,500 or $25,000 if I'm married. Same type of income phase outs, $150,000, $300,000. For both no tax on tips and no tax on overtimes, originally they were supposed to be disclosed for W-2s and 1099s for tax years 2025. Relief came out that said that's not going to be practical for most employers. So nothing actually needs to be disclosed under W-2 or 1099 when it comes to tips or overtime for tax year 2025. So if you're an employee and you think one of these provisions can qualify for you, you might need to ask your employer for a separate statement as to how much actually qualifies, because you're not going to get something on your W-2 or 1099 that says, well, this was your qualified overtime pay or this was your qualified tip pay, because this is a deduction that you're going to claim on your personal return. It's not going to be a deduction that shows up on the business return. So you might have to do a little bit more work on your end for 2025 to know what the amounts are that you need to report on your personal return. But then starting for 2026, which we don't really file until 2027, then you should get a statement on your W-2 or 1099 about the qualified amounts involved. So we have a chart in here that goes through some of the high level items for, okay, no tax on tips and no tax on overtime. No tax on car loan interest, similar to no tax on tips, no tax on overtime. It's not really getting rid of the tax on it. It's just providing a potential deduction that's out there for certain types of car loan interest. What this will be is a new form will get issued out to taxpayers, which shows if you have this qualifying interest that's paid. There are some adjusted income phase outs we see, so $100,000 and $200,000 if I'm married. This only applies to vehicles I use for personal use and not business use. And I will need the VIN in order to claim the deduction on my return. Personally, I'm not sure how many people will actually be able to qualify for this deduction based on some of the AGI limitations. And there are some requirements for the vehicles and where they need to be manufactured, which makes it a little challenging for a number of vehicles to actually qualify for me to take this deduction. Furthermore, this is only applying to new loans. If I have a pre-existing loan, I'm not going to be able to take some of this deduction either. So when you actually get through all the different qualifications, it's going to be pretty tough to actually qualify for this deduction for the no tax on car loan interest. So keep that in mind if this is something you're thinking about. There's many more hoops to jump through before you can actually qualify for the deduction.
I believe one of the limitations was final assembly has to occur in the US, which is a big limitation, so.
And we saw that with some of the green energy credits in the past for vehicles, that final assembly in the US is just a tough standard to meet just based on where cars are made now. Trump accounts, interesting name, but there is a new investment account out there for certain children that was brand new. Keep in mind, this doesn't actually start until July 4th of next year, so July 4th of 2026. What this is basically a mini IRA account for children that are under age 18. You basically can make a contribution of $5,000 a year into these accounts, but you do not get any type of deduction for it. So you can put the money in, but you don't get any type of tax benefit for the actual contribution. And then the children can't take any of the money out until they're age 18. And after that point in time, they can take it out, but with a penalty, just like the IRA rules. And then it's only when they reach retirement age can they start taking it out. But when they take it out, that is taxable income to them. So it acts like a small IRA account, basically, new type of investment vehicle set up for children. As part of the bill itself, it mentioned that if you were a child born between years 2025 and 2028, you will get just an automatic $1,000 into these accounts set up by the government. You, as the parents, have to go and file this form 4547, which should be ready sometime next year in order to claim the seed grant. But it's basically free money that's out there into some of these accounts. If you've been looking around in the news recently too, I think it's the Dell family that just came out and did a big grant for these accounts as well. Basically a $250 seed grant if I'm a child that's under age 10 and I wasn't born in between 2025 and 2028. So if I'm a pre-existing child, I could potentially get this $250. Now, this is not part of the actual tax bill itself. It was just some charitable pledge that got made relatively recently. And what it looks like is they're expecting 80% of children ages under 10 to actually qualify for this $250 seed grant. Still up in the air how it works, but basically they're looking at zip codes. And if you're a child in a zip code where the median income is under $150,000 per household, then you can qualify. So it's not even really based on the parent's income, it's what zip code do you live in? And if you take a look at some of that, a lot of those zip codes that don't qualify are in New York or California. When I took a look at the map for Nebraska, I only saw one zip code that wouldn't qualify, and that was somewhere out east of Lincoln. So that $250 is not part of the bill, but it is something that's out there. And they say they're going to have this special form 4547 where you can make this election to open the account and claim some of the seed money. They also said that they're trying to have that ready for filings with your 2025 tax returns. So it wouldn't have to be a separate filing. You could just do it with your income tax return as well. I'm not so sure that's going to be ready by the time we actually have to file returns, but they are setting up some type of electronic process we'll hear more about in May if you're interested in opening up one of these accounts. And then we have a slide in here that just talks about some of the requirements when you can take money out, so on and so forth. In my personal opinion, the 529 accounts, the Nebraska Nest accounts, are a better option than having to open up one of these Trump accounts because it's basically just a small IRA for certain children. But if I had the option to do both the 529 plan and these new Trump accounts, I would recommend doing both. But if you had to pick one or the other, the 529 account gives you much more flexibility than this Trump account. And there's still a lot of open questions about what's going to happen with these Trump accounts and how to qualify. I'm sure we'll get more guidance next year.
Now we're going to go over some education and dependent care updates, starting with the 529 plans that Dan just mentioned. A 529 account is a tax advantage savings plan designed to help families save for education expenses. So when you put contributions in, the earnings grow tax-free and the withdrawals are also tax-free as long as you spend them on a qualified expense. Keep in mind that these are state plans. So like Dan said, for Nebraska, it is called the Nest 529 plan. And with the One Big Beautiful Bill, they have changed that now there's a new expanded list of K through 12 expenses that qualify for these 529 expenses, also known as qualified higher education expenses, which includes tuition, books, online education materials, and so on. This applies to public, private, and religious schools, but keep in mind that yes, the federal government allows this, but 529 plans are state plans, so also states have to allow for this expensing. And as far as I've heard for Nebraska so far, I haven't heard whether or not these are allowed or, if they're leaning one way to allow them or not, but I'm sure there'll be more updates to come, next year. And another change with 529 plans is the K through 12 expenses that are allowed have been increased to $20,000 a year per beneficiary starting in 2026. Also, these funds now can cover not only a regular, 4-year college, but also post-secondary credentialing programs, which would be something like, an apprenticeship or a community college certificate. So now you can use your 529 plans on those expenses, but also keep in mind that it has to be a recognized post-secondary credential program, and they're subject to certain restrictions, and usually states will have a list of all the programs and credentials that qualify to be used for 529 expenses. There is also a new scholarship tax credit, which is a credit for donation to scholarship granting organizations that fund K through 12 scholarships within their states. This will be $1,700 and it starts in 2027, but there are some restrictions. It's cash only. If you received a state tax credit, the federal credit has to be reduced by that state amount. Also, you can't double dip, so you can't take a charitable donation, deduction, and credit at the same time. Also, states have to provide a list of qualifying organizations each year, but keep in mind this isn't until 2027, so there will be more regulations that come out about this. Some other updates to education and dependent care. The first one being the dependent care assistant program has increased exclusion from $5,000 to $7,500. Also, the enhanced child care credit for employers has been, like I said, enhanced and increased. So this is a credit for employers who provide on-site or subsidized childcare to employees. And then employer student loan payments was going to expire, but this has been made permanent as well. So individuals can exclude from income up to $5,250 annually for student loan payments made under employer assistance programs, and this will be indexed for inflation starting in 2027. Switching gears to green energy tax credits, there are residential ones as well as business ones. And keep in mind that pretty much all of these credits are now set to expire or slowly phase out throughout the years. So first we'll talk about residential tax credits. There are 2 of them. The first one is the energy efficient home improvement credit, which is for energy improvements and expenditures, things like doors, windows, skylights, insulation, roofing, heat pumps, water heaters, and so on. And then the second one is the residential clean energy credit, which is a credit for alternative energy products that rely on renewable energy. So this would be things like solar, wind, and geothermal. Both these credits are going to expire after 2025. So if you want to make any large improvements or buy any, doors or windows for your personal residence, keep in mind that you will have to purchase those items and put them in place before 2025 ends. Also, the clean vehicle credits expired on September 30th of 2025. And there were 3 of these, which were the new clean vehicle credit, used clean vehicle credit, and qualified commercial clean vehicle credits. These credits had, intense restrictions, whether it was MSRP limits, AGI limits, and so on. So we personally didn't see a lot of clients that were able to take these credits. So maybe not a big deal, but if this was something that you were interested in, just know that they did expire on September 30th. Also, the alternative fuel vehicle refueling property credit expired June 30th, which would be if you, installed charging stations in your house. Those are no longer a credit either.
Moving on to some of the estate and gift exemption changes. Last year, some of us were very worried about this one because this was one of those provisions that was supposed to quote unquote sunset and basically drop in half, where we go from, say, I don't know, 14 million to about 7.5 million, which would impact a lot more households and a lot more people would actually have to worry about this separate estate tax, which is a tax independent from the income tax, where it's basically a tax on 40% of your assets when you pass away. But there's an exemption limit for your total number of assets. Thankfully, with the bill, that limitation did not drop. In fact, it increased and it's going to be permanently inflation adjusted going forward. So that gives us a little bit more consistency in this area, allows us to do a little bit more planning. As you see here, the exemption is $15 million per person, but really if you're married, you can have $30 million worth of assets before you even really need to worry about the estate tax coming into play. From what I heard with these increased exemptions and this inflation adjustments, if you look at just the state of Nebraska, there's projections that only about, say, 2,000 households in the entire state will actually be subject to this estate tax going forward now with these increased exemptions. That being said, too, there was some talk earlier in earlier drafts of the bill about, hey, do we just get rid of the estate tax overall? But with these increased exemptions, it seems almost impossible that the estate tax would go away going forward. With the higher limits and less taxpayers actually being subject, this is something that's probably just going to be permanent. I don't see it very likely that anytime soon that the estate tax itself will be repealed. And just for a little bit more context, if you look at 2023 and the amount of taxable estates that were filed that actually paid tax in the state of Nebraska, that number was less than 30 tip returns in total. So less than 30 returns in the entire 2023 tax year where people actually had taxable estates where they were paying tax. So it's going to be an even smaller number of people that this is going to be subject to going forward. So it's nice to know that we have some guidance that's going to be inflation adjusted and we have the higher limits without it dropping down to, say, 7.5, where a lot more people would actually end up being worried about being subject to this tax.
The Secure 2.0 Act was signed into law at the end of 22, and it made a lot of changes to retirement plans, such as required minimum distributions, catch-up contributions, automatic enrollment, and so on. There were a lot of changes that came into play in 2023 and 2024, but there are still a couple of changes that are going to happen in 25 and 26. So we just wanted to go over those. This chart shows the different retirement plan options and limits going from 2024, 2025, and 2026. I won't go into detail on these, but just know that this is a chart that you can refer back to if you're wondering what the different limits are for the different retirement accounts. One of the changes that is going to start in 2025 is to catch-up contributions, and this is dubbed the super catch-up contributions. So individuals who are over 50 have historically been able to take an additional catch-up contribution, but now they are able to contribute even more if they are age 60 to 63, known as super catch-up. And this is equal to $11,250 for 401ks, 403bs, and 457b plans. So for 2026, let's say you're 49 and under, you're able to contribute $24,500. If you're 50 to 59, you can contribute an extra $8,000. Then when you get to 60 to 63, you have the super catch-up. But when you get to 64, you go back to $8,000 of a catch-up. So that is what the super catch-up contribution is known as. Another change that will happen in 2026 is mandatory Roth catch-up contributions. So if you're 50 and over, you're allowed to make catch-up contributions. But if you're considered a high earner, or you have FICO wages over $150,000, you're now required that these catch-up contributions are Roth only, also known as after-tax contributions. So you don't have the option starting in 2026. Now that we have gone over individual updates, we are going to switch gears and go over business updates. Starting with the TCJ updates or TCJA provisions that were extended or made permanent. Here is a quick summary of probably the four biggest updates with the new bill that we're going to discuss in detail. First one being bonus depreciation, section 179, business interest, and then R&E expenses. So we will start out with bonus depreciation. The TCJA made bonus depreciation 100%, which basically states for a lot of fixed assets that you capitalize, you're able to take 100% of an expense in the year that you capitalize them. But the TCJA also had a phase out. So in 2023, bonus was 80%, 24 was 60%, and 2025 was set to be 40%. But now with the new bill, bonus depreciation has been permanently reinstated to 100%. But keep in mind that it's starting as of January 19th, 2025, which was the inauguration date of President Trump. So it's just important to keep in mind that if you have assets that were added, between January 1st and January 19th, you aren't able to take the 100% bonus. It will be the 40%, which was the rate for 2025. But afterwards, you can permanently take 100% depreciation. There also is this new provision for qualified production property, which is non-residential real property, uses an integral part of a qualified production activity. And you're now allowed to take 100% bonus, which is a big deal since real property usually is not allowed to take bonus depreciation, and you have to capitalize and depreciate it over either 39 or 27.5 years, depending on what the property is used for. Now, if this property qualified as, a QPP or a QPA, you're able to take this 100% depreciation. However, there are a lot of restrictions and still a lot of questions with this provision. One of the restrictions is that construction has to begin between 2025 and 2029, be placed in service before 2031. Also, it does not include offices for sales or R&E property or leased property. But keep in mind that this is a new provision and it's something that, if you're interested in, you might want to reach out to your tax professional and ask them a little bit more about if you qualify for this.
And I want to jump in here real quick because I haven't actually seen anyone actually trying to take advantage of this provision yet. So I would be very cautious. Leslie just jumped through a bunch of the different hoops you have to go through to qualify. And it's a pretty big investment, hoping that this provision will still be around for when you can actually take the 100% expensing on it. The whole point of this provision was to try and encourage more building of manufacturing facilities and factories here in the United States. And if you could build that new factory, you could completely write off the cost of the building itself. It's not quite that easy when you actually read through some of the provisions. So I want to get super excited about this provision. If you're thinking, well, I can just build a new factory, new manufacturing facility, and completely write it all off. It's a lot more nuanced than that when you actually get into some of the details. And I'm sure we'll get regulations that further scale back the actual benefit of this provision. So I would just say tread with caution for this one. It sounds great, but when you get into it in practice, probably not going to be as great as you think.
Section 179 depreciation also has increased expensing limits. The maximum deduction is $2.5 million. But if the cost of the property placed in service is greater than $4 million, the 2.5 limit starts phasing out. Section 179 had become popular when bonus depreciation was phasing out year over year. It's pretty similar to just regular depreciation expense with some limits. For example, Section 179 can't exceed taxable income, so you can't take it if you're at a net loss, or if by taking 179 you get to a loss. So it is more limited than bonus, we have seen it, but now that bonus is back to 100%, it's very likely that businesses won't be taking Section 179 as much as they were before. The 163J limitation also changed. So this limitation just says that the interest expense that you take on your financials is capped at business interest income, 30% of adjusted taxable income, and floor plan financing interest, which is indebtedness used to finance the acquisition of motor vehicles held for sale or lease. So when you can't take your business interest expense, it can be carried forward. And there is a big exemption that applies if you're considered a small business. So if your average gross receipts over the past 3 years are less than $31 million, you don't have this limit. So this makes a lot of taxpayers exempt and don't have to even worry about this limit. But with the TCJA, the adjusted taxable income was limited to EBIT, earnings before interest and taxes. But now, starting in 2025, we're going back to the EBITDA standards, which is just earnings before interest, taxes, depreciation, and amortization. So it makes it harder to be, limited, which is a good thing.
So yeah, we'll probably see more freed up business interest expense going forward now that we can add back depreciation and amortization. When that disappeared from our calculations, we saw a lot more business interest being held up as non-deductible. One caveat I want to throw out here is this is a federal tax law change. Depending on your state might not be following the same type of adjustment. So for federal purposes, you could be deducting more of your interest expense. But if your state doesn't conform, well, for state purposes, you might still be just as limited as you were before.
There is also this new 163J limitation for capitalized interest. A good example of this would be if you're a construction company that capitalizes your interest into inventory before you sell the property. You now not only have to consider both your interest expense that's on your income statement, but also your capitalized interest that's on your balance sheet. And we have an example up there that I won't go into too much, but just know that now you do have to worry about capitalized interest as well, but you only have to worry about 163J if you are over the average gross sales limit of $31 million.
One change that I was very excited about is something we've been trying to get for I don't know how many years now, a very long time, where we had our research and experimental expenses, where we were required to capitalize them and amortize them over a period of time. Thankfully, with this tax law change and the One Big Beautiful Bill, any of those research and experimental expenditures can now just be fully expensed. So we don't have to amortize them over a period of years anymore if I'm domestic. If I'm foreign and I'm foreign research and experimental, that still has a 15-year amortization period. However, for domestic research expenses, I can go back to fully expensing that, which is quite nice and not having to worry about my amortization period. They did come out with some relief as well. So this is a retroactive provision. So you can go back and amend back to 2022 to fully expense your research and experimental expenses for that period of time, if I'm a small taxpayer. And we have a chart here that walks through if I have 174 costs, these research and experimental costs in the past, what are my different options to try and free that up? If I'm a small taxpayer, which is at $31 million gross receipts threshold, I can go back and do an amended return and claim it for those prior years. But if I'm a larger taxpayer over that $31 million, my options are basically to claim it either in 1 year, my remaining amount, or over a 2-year period of time for what I had left on my amortization period. But this is a pretty nice provision going forward. Research and experimental can now be 100% expensed. Business meals. This one might come as a surprise to some people because my 50% deduction for employee meals is going to be change for 2026 going forward. What they're really getting at here is those deductions for the convenience of the employer, where I have one of two situations. I'm a big tech company on the West Coast, and I have a cafeteria for my employees. I could, in the past, take a deduction for those employee provided meals at the cafeteria. That's just gone. It's going to be completely non-deductible for the business going forward. The other example that they're trying to get at is businesses who bring meals on site for their workers in order to keep them longer. I like to think about, say, a hospital. I have some doctors that are working. Hospital brings the meals to feed the doctors so they can work later, do their surgeries. In the past, that was deductible 50%. Now that's just completely non-deductible. We're not taking a route about getting all business meals, but really just those meals for the convenience of the employer. So the cafeterias bring meals on site. I can still have my holiday parties. I can still do some de minimis meals for my employees, but I can't do this bringing the meals on site really is the big one. And my meals with my clients, still 50% deductible. That did not change. Really, this provision was aimed more at the bigger tech companies and stopping bringing all this food that they would do over there. And that does not start until 2026 though. So for 2025, you're still fine. Excess business losses, basically this now became a permanent provision. If I have too much of a business loss, I could only take so much in my first year of the loss. And then any other amount basically gets disallowed for the year and becomes a net operating loss in a subsequent year. So if my business loss for a year was too large, I get limited to that 313 or 626,000. The excess amount of that loss rolls forward to the next year, and I can use it for future years. I just can't use all of that loss for the current year. Pass-through entity tax, with the increase to the SALT limitation to now be $40,000 for individuals, we were getting some questions about, okay, does it still make sense for us to do this tax election on our S corporation returns or partnerships and pay tax at the business level now that we have like the increased limitation? And the whole point of this pass-through entity tax was to get around that $10,000 cap. It still makes sense. You still get more of a benefit from doing it this way, because if you had more than $40,000 in taxes, you get more of a benefit. If you don't itemize your deductions, you wouldn't be able to get a benefit. So what we're recommending is still keep doing that pass-through entity tax election. It's still going to give you a benefit rather than stopping that and just picking up the taxes on your personal return. There are some state issues with this as well, so I would watch out. Some states just stopped their pass-through entity tax in 25 or 26 because it was tied to the federal SALT limitation. And since that changed, some states just automatically stopped theirs. I think California might be one of those states that would be one of the big ones. And I think they just deferred it to like 2026 as well. So keep in mind that your local state, Nebraska is not one of those states, but that could change where you say, well, I want to take this pass-through entity tax election and your state might not still offer it.
Next, we'll go over the removal of business green energy credits. Keep in mind that we're only going to go over a couple of the big ones, but pretty much all of the green energy credits are expiring. So just be aware of that if there's one that you've been interested in and it's not on these slides. The 179D deduction is set to expire. This is a deduction for commercial building owners or architect, engineering, or design firms that make energy efficient improvements. The new expiration date is that construction must begin before June 30th, 2026. In order to claim this deduction, you need at least a 25% reduction in total annual power and energy costs. And also a big thing is that usually a 179D study is required to be done by a third-party firm in order to confirm that you had this, at least the 25% reduction in total annual power costs. But I believe for 2025, the deduction is about $6 per square foot that you can take, but just note that this one is expiring. The clean electricity credits also have been pretty common that we've seen. There are two different credits. The first one is the 45Y, which is a credit for the amount of electricity that you produce. The second one, more common, is the Clean Electricity Investment Credit, which is a credit that you get based on the total cost of the project. So basically the amount that you capitalize. But these credits are expiring based on the type of project that it is. So if it's a wind or solar project, it will expire first based on if it's a different type of project, such as geothermal, battery, hydropower, and so on. And keep in mind that starting immediately, the government has enacted that projects are subject to strict foreign entities of concern restrictions. And this says that if you receive material assistance from a prohibited foreign entity, or if you have ties to a foreign entity, such as ownership, that you won't be able to receive these credits. And this isn't just for these credits. I believe it's for a majority of the clean energy credits. And these foreign entities of concern are countries like China, Russia, Iran, and North Korea. So that's something to keep in mind, that they're really cracking down on these foreign restrictions.
Opportunity zone investments. This might be a blast from the past for some people out there. We had these opportunity zone investments a few years ago. You had to get on at the onset of these to really get the full tax benefits that were out there. But now they're restarting this program with a brand new set of opportunity zone investments. These don't really start until 2027, but we want to get it on your radar because you can start seeing what some of these new opportunity zones are in July of next year. And what it basically does is it allows you to get a basis increase for your investment in these types of funds, and you get a tax deferral on your capital gains that you invested for a period of time. And that benefit for the basis increase gets even better if I'm in one of these so-called rural funds, where I go from a 10% basis step up to a 30% basis step up. We're still waiting on more guidance about how this is going to look. The one thing that's different from the old program is these will be rolling 10-year investments. So you don't necessarily have to jump in on it right at the very beginning to get the full tax benefits. You can find something that's just ongoing too, and still get some nice tax benefits, as opposed to, well, first year that this comes out, I really need to get involved in here, or else I'm really going to lose the full extent of my tax benefits. Opportunity zones coming back. High level, if I have capital gains, I can invest these in one of these types of qualifying funds. I don't have to pay tax on that capital gain right away. And if I hold that investment for a period of time, well, then I can get a basis step up and potentially even a gain exclusion when I go to sell that investment. So nothing to worry about for right now. There will be more coming out about that. We just wanted to bring it up that you might start seeing more of these. And it's a little bit more permissive as to when I can enter into one of these investments than what it was in the past. Some payroll things that we think would be a good idea just to keep you in the loop of. The bill itself wanted to crack down even harder on these employee retention credits. It's been a number of years since those claims have really been out there. But if I'm one of these promoters or I follow the fraudulent claim, they really want to crack down on it some more. And they were concerned about fraud in this area. Back to these Trump accounts again. Earlier, we talked about it more on the individual side. And if I'm a parent or a grandparent that wants to put money into one of these accounts, what does that look like? Well, they also have an employer portion of this as well, where employers can set up a program kind of similar to their cafeteria plan, where there can be up to $2,500 tax-free contributions into the accounts, well, if the child's under 18 for their account directly, but for parents and their dependents, where the parent can have a contribution in from one of their children into one of the child's Trump accounts. There are non-discrimination rules, notification rules. Unlike on the individual side, where I give that $5,000 and I don't get any type of deduction, on the employer side, that would be pre-tax, that $2,500. And that $2,500 counts against that $5,000 limit, which I know sounds pretty complicated about how all this qualifies. We still need some guidance on how it works, because it doesn't even answer the question about what if I have multiple children? How do I split that up? So I just want to throw it out there for employers. You might get questions about this and offering this to your employees at some point in time, but it's still way too early to really even know what some of the requirements are or how the actual details work in practice about getting these set up and actually running these types of programs. But it's not just on the individual side, there is also an employer portion to these Trump accounts and how they can get funded.
Going back to the temporary no tax on tips deduction for the employer side of things, like we said, the IRS businesses are required to report tips on W-2s and 1099s, but this isn't until 2026. So for 2025, the IRS is really saying that you should use reasonable methods to be able to provide your employees with the information that they need to report this deduction on their individual return.
And I think we should mention on these no tax on tips too. They tried to make it so you can't get too cute. I can't say, well, I'm an accountant. I've always been paid a salary. Now I want to get paid in tips instead. So I can qualify for this deduction and I can offset some of my income. It doesn't work that way. They have a list of, I think it's like 60 different occupations, which are occupations that historically receive tips in their words. And it's only for my historical occupations that receive tips that can actually qualify for it. So if you normally have taken a salary, there's not a way for you to switch and say, well, I want to start taking tips now. They really want it to be for the historical industries that take the tips. Those are the ones that can get some of the benefits.
Same thing with the no tax on overtime. For 2025, it's really just you're supposed to use reasonable methods to, determine how much is overtime and report that to your employees. If you're not exactly sure how to do that, I would recommend just reaching out to your payroll company or really just deciding how you're going to report that for 2025. Since starting in 2026, we should have these new forms, W-2 and 1099, for reporting to your employees. It is important to note that since there's no guidance for 2025, you shouldn't have any penalties from the IRS if you don't report anything too well. So no penalties for 2025, but in 2026, they are likely to start.
Besides the Trump accounts, this is the second provision where I've got the most questions on. How does it work for like this no tax on overtime? What counts? That tends to be very technical and specific. So you really need to talk to your payroll company and look at the FLSA for what type of overtime actually qualifies, because it's not all types of overtime. There are some restrictions that are out there. So it's a little bit more involved than just saying, well, I have overtime, I can include it into my potential deduction. It's much more nuanced, unfortunately, as to what actually counts as qualified overtime pay. You really got to look at that FLSA.
There was some transition relief that came out in November where the IRS is saying that there is transition relief available for 25, only not available for 26. And this is because the IRS specifically saying they're not going to update its 2025 forms W-2s and 1099s, but they will for 2026. And like Dan said, that they did come out with a list of occupations that regularly receive tips and even more regulations and assistance to help you out. There were some updates to the paid family and medical leave credit. So historically, you had to use a percentage of wages paid during family and medical leave, but now employers have two different options for choosing how to calculate the credit. There was some expanded eligibility and rules, and just note that this all applies starting in 2026. Also, there was the extension of the tip credit. This is also known as the FICA tip credit, which is designed to offset a portion of Social Security and Medicare taxes paid by employers on employees' tip income. So now it includes beauty service businesses, which is hair care, nail care, aesthetics, body and spa treatments, and so on. And this applies for 2025. So note, if you have one of these businesses, you can apply the tip credit. We'll now talk about a couple of other business provisions that we think will be helpful to know. The first one being information reporting. So third-party network transactions are payments from third-party settlement organizations or payment apps such as PayPal and Venmo. Historically, these payments were the threshold for reporting on a 1099-K has been over $20,000 and 200 transactions within a calendar year. There was a new act that came out a few years ago that was going to decrease this significantly. And I know a lot of people were worried about this, stating, if I'm being paid through Venmo, am I going to be receiving a bunch of different 1099-Ks? But just know that there has been the reinstatement of the old thresholds, which was $20,000 and 200 transactions. I believe for 2024, the threshold was $5,000, and for 2025, it was gonna be $2,500, but effective immediately, it has gone back to that old threshold, which is a good thing. Also, with information reporting thresholds for 1099 NECs and miscellaneouses starting in 2026, the threshold has been increased to $2,000. For 2025, it is $600, but then it will bump back up again to $2,000 2026 and also be adjusted for inflation going forward. Couple of updates for C corporations is the charitable deduction floor. Just like individuals, there is now a new 1% haircut for charitable deductions that will start in 2026. Also, historically, for C corporations, charitable deductions can't exceed 10% of taxable income. That threshold is still in play, but there is a 5-year carry forward. So just know that C corporations, it'll be harder for them to take charitable deductions. And then also for C corporations, there is this new executive compensation limit, but this is for publicly held corporations, whereas their compensation for covered employees is limited to $1 million. And this is CEOs, CFOs, and the 3 highest paying execs. And this also starts in 2026.
For those of you that have been patiently waiting for the polling question, I promise you it's coming up here in about 2 slides. After the polling question, we just have some quick other updates about other things and other trends we're seeing, and then we'll get into the Nebraska updates, which there aren't really that many. So thanks for sticking around for the polling question. I promise it is coming up here very soon. Before we get into that though, farming. There was a special provision put in there for farming, which basically kind of allows installment sale treatment for sales of certain qualifying farmland property from one qualified farmer to another qualified farmer. I heard from the guy that actually drafted the provision that sent it to Congress, included into the bill. What he told me was basically what he wrote and what got into the bill were 2 completely different things. So if you're interested in this, there's a lot more hoops to actually qualify for and jump through, but it basically allows a farmer to sell some of their farmland and get an installment sale treatment for a period of time, but I need to have a farmer on the other side as well. Nonprofit updates, just very, very quickly. The earlier versions of the bill in the House had a lot of different impacts potentially for nonprofits. The only one that really made it all the way through is this endowment tax, where it now introduced a graduated rate on the investment income for certain colleges and universities, which are typically your Ivy League schools, with certain endowments and asset ratios. And at long last, we're now at the polling question. We'll take a quick pause to send that question out, then we'll get back into the rest of our presentation. Well, that was your window of opportunity to answer our polling question. We're gonna keep moving forward. So hopefully you were paying attention at this particular moment in time, so you could jump in and answer our very difficult question, so you can qualify for your CPA. We thought it'd be worthwhile just to mention what's going on with the IRS. We had this whole Doge initiative at the federal government. What really happened there? Well, if you take a look at it, the IRS workforce basically lost 26% of their employees from all that. We had about 102,000. We went to 76,000 after some of the reduction in forces. I know they're starting to hire some of those people that were let go back to the IRS, but we're still down agents. And I know we've definitely felt it here. We're just trying to communicate to the IRS or get information. There's just not as many people that were there as before. And the two areas that really took the hit were the small business division and the tax exemptor division. Those took the biggest hits for loss of employees. Government shutdown. I think it's also worth mentioning that we had a government shutdown October 1st to November 12th. What basically happened during this period of time is only 53% of the IRS employees were deemed essential to work. So of our 76,000 employees, that number gets cut in half to how many were actually working for this 43-day period. Not great. We definitely felt it on our end. A lot of the essential tasks were still there, but if you were trying to do any type of correspondence, it was not good. And I'm still feeling the effects of just the backlog of about, say, a month or two where no one was really getting back to correspondence. It was just piling up, and we had letters just stack up, stack up, stack up. So hopefully we'll get some type of relief there soon. But we want to mention wasn't exactly great for having good correspondence with the service so far with some of the changes. The IRS also released what are the issues they're looking for the next fiscal tax year that they're worried about. It's three big things. The first was actually going after nonprofits, 501c3 organizations, and really colleges in particular. If I'm a private college, they want to make sure you're not doing anything discriminatory and you're not engaging in too much political activity. That was their priority, and I think you might have even seen some of that in the news lately with how they're treating certain colleges. Item 2 is just doing regulations for the one big beautiful bill. Passing the regulations that are needed to clarify the provisions. Item 3, they want to talk about deregulation and getting rid of unnecessary regulations. On their list, they had 46 different regulations that they wanted to just eliminate because I think they're worthless. As I was going through that list, there were none of like the mainstream provisions that you or I would use day to day. It's definitely some of the more niche provisions that are out there, but that is their goal, to start reducing down some of these older regulations or stopping some proposed regulations that never went anywhere. So those are the three big campaigns that they're talking about. I don't really see any type of enforcement campaigns out there except against the colleges. So their priority guidance plan this year was much smaller than some of the prior years where they had all these different topic areas they wanted to get into. They really didn't have all that much for this upcoming filing season. Corporate Transparency Act, we made a big deal about this one a few years ago about, well, you got to make sure you file with FinCEN to make sure you have all this stuff ongoing. Then we had the court case where they were arguing about the constitutionality about, well, is this even constitutional to begin with? Which kind of put it in limbo for most taxpayers where they didn't need to file. We got an interim final rule about this, if you're curious, and it really exempts a lot of US people and the US companies. So if I'm a US person or a US company, I don't have to report. The only one they're really targeting to report are foreign-owned businesses that are actually doing business here in the US. And even with that, there's some court cases ongoing where the whole Corporate Transparency Act should just be thrown out even for the foreign individuals and foreign businesses. But if I'm a US person, US business, I don't have to worry about getting anything filed for this for right now. They really walked back to who's really going to be subject to this reporting requirement. Some forms we just want to mention. This form was new for back in 2024, but I think we might see it a little bit more. If I'm getting property from a partnership, I have to file this form as a partner with my partner's return, just saying what type of property I got. Typically, the partnership will report this information to me on my K-1 about what I've received, but that is something that's relatively new out there, where if I'm getting property that's not cash from a partnership, they want a lot more information about what I'm actually receiving and how I received it. And then we have forms for digital assets, so basically cryptocurrency. In my opinion, this has been a very long time coming where we get something to report on this. It's not all that far reaching though, and it's really not going to help you for your tax reporting purposes, in my opinion, because it will be issued for tax year 2025. The only thing that the form's required to report is your gross proceeds, so not even basis information. So you still need to be keeping track of your basis information to figure out what your actual gain is. They're just going to be talking about gross proceeds. Furthermore, while they said they're going to start doing basis information for tax year 2026, that's not quite true either, because they're only going to start that basis reporting for assets that were purchased as of 1/1/2026. So if I have any historical cryptocurrency holdings, I'm not going to get any basis information on that. It's basically going to be treated as a non-covered security. I'm still on the hook for trying to figure out what my basis is there. So it's only going to be for new assets acquired after 1/1/2026 for that basis reporting, and gross proceeds are just going to report for 25. In my personal opinion, this really doesn't help us out at all for trying to report these assets. It's still a very manual involved calculation to figure out what is my gain on my token holdings.
The last new form that we're going to go over is the new Schedule 1A that is going to be attached to your Form 1040 starting in 2025. Keep in mind that this is a draft, but this is to help you report the new provisions that came out, such as the no tax on tips and so on. So in Section 1 that you see, you calculate your modified adjusted gross income that helps you identify your limits for each deduction. And then it just goes section by section for no tax on tips, overtime, car loan interest, and also the enhanced deduction for seniors. So it's unlikely that someone's going to have, all of these sections filled out, but if you were going to have just one, such as the enhanced deduction or the no tax on overtime, you're going to have to fill this out and have it attached to your Form 1040 for 2025. There was a new act, the Math Act, that President Trump signed on December 1st. This isn't that big of a deal, but it just requires that the IRS provide specific information when it makes tax return changes due to math or clerical errors. Historically, the IRS could send you a notice that changed your tax due or, put penalties and interest into play and not really provide you any information to why that is the case, which is frustrating. And then, you have to call the IRS or sign a POA with your accountant and have them call. Now the IRS has to provide the following information if there are math or clerical errors when they're sending out a notice. So this is really a good thing that hopefully we maybe won't be contacting the IRS as much.
I still agree with what you said at the very beginning. This really doesn't do very much for us at all for what we do. If you're even using like a TurboTax, it should get the math pretty much correct. This is pretty much for people that self-prepare their own returns. They don't use a tax professional, and it tells them what the math error there might be was. We typically don't see math errors like at all because we do all the calculations and we'll know what's going on. It's usually some other thing if we're getting a notice rather than just a pure math error. But this should help people who aren't using a professional or are not really using a good tax software to find out some more information.
We are going to end with some Nebraska updates. Keep in mind, if you have any questions, put them in the chat and we might have some time to go through a few, but if we don't, we'll make sure to contact you and let you know our thoughts on the questions that you have. So we'll start out with the Nebraska income tax rate changes that was enacted by LB 754 in 2023, which just really gradually reduces Nebraska's top income tax rates and collapses from 4 brackets to 3. So in 2024, the highest rate was 5.84%, 25 will be 5.2%, followed by, you can see it reducing in 2026 and 2027. Keep in mind that the Nebraska PTIT rates follows the top tax bracket. So for 2024, the PTIT rate was 5.84%. And for 2025, it's going to be 5.2%. So this is really a good thing for us Nebraskans that we have lower income tax rates, which is nice.
A quick off the record, I go unofficial comment here. You might have seen in the news that we are facing a budget shortfall here in Nebraska of several hundred million. From what I am seeing, there is no plan to change some of the tax brackets. One of the proposals I was put out there to try and help with the shortfall was, well, let's stop stepping down our rates and lock it into whatever it is now, or go back to some of the older quote unquote higher rates. But that has not been something that's been thrown out there. So it looks like we're still on track that each year we're going to reduce down our tax brackets, even with the potential budget shortfall. They would find some other way to pay for that.
We also wanted to bring up the Nebraska property tax credit. Historically, you've been able to take this credit on your Nebraska personal income tax return. And you've been able to take a credit for both the portion of school district property taxes and community college. Starting in 2024, so we talked about this last year, the school district portion wasn't able to be taken as a credit on your return. It was just offset your bill that you receive as a credit. But now going forward, it's just going to be the community college portion that you're able to take as a credit, which was the case for 2024. So we'll still have this credit on your 2025 Nebraska return and going forward, but just know that it's just going to be for 100% of the community college portion. So it was smaller in 2024 and it will continue to be the same for 2025 and going forward.
And that community college property tax rate is relatively small compared to what it used to be when we were taking the full amount of the property tax credit. So it really isn't even that much to really even like mention when you get into it for how much that community college credit is, but it is still around and something to think about because it does still exist. Pass-through entity tax, we mentioned this a little bit more on like the federal side of things, but that is still around for Nebraska. Nebraska did not change that. The only thing that's worth mentioning is you have until 12/31/25 if you want to do that retroactive election. We're coming up onto the end for when you can do the retroactive election for some of the prior years. This is going to be the last year to do it. And then we have just the different PTET rates that are on there. Like Leslie said, they mirror the Nebraska tax rates and they step down over time. Last thing we have is this new provision that got passed in Nebraska about foreign adversarial company reporting. Leslie mentioned this a little bit on the federal side, and this is some type of trend we're seeing. If you're doing some type of transactions with a quote unquote bad country like Russia, China, Iran, North Korea, you have some more limitations on some of the credits you can qualify for under Nebraska. If you're doing transactions with one of those countries, you might not be able to take advantage of some of the Nebraska credits and grants that are out there, and you'll lose your eligibility, which just something to keep in mind. If you're dealing with countries that are a little bit more interesting out there, we have a list here. If you're doing business with some of these countries, just be cautious. You could lose some of your Nebraska tax benefits. This is a new thing that just recently was passed. And with that, we're at the end of our presentation pretty much. If you have questions, let us know.